Hi, everyone. My name is Mark Reyes. I am on the marketing team here at Build, and I'm excited to welcome you back to our Build virtual meetups. Today's topic is on how to account for the cost of your working capital to increase profitability. And I'm happy to be joined today by two construction industry veterans. Travis Mayer is the Director of Strategic Partnerships here at Build, and he works with subcontractors every day, helping them to improve their financial performance and cash flow efficiency and increase their profitability. Along with Travis, we have Jerry Aliberti, who is the owner of ProExcel, and Jerry works with growth-minded contractors, helping them build and scale their businesses through strategic growth planning and improved operational performance. On today's meetup, we're going to be discussing the importance of accounting for the cost of your working capital and including that cost into your bids. So we will start by explaining the steps you can take to better understand what your working capital options are and to measure your current cash flow to get a clearer picture on what your financial options are. And from there, we're going to help you determine the cost of capital for each working capital option at your disposal. There's a cost to using each one of these, including just your cash. And then we'll share the benefits of including the cost of working capital into your bids. Lastly, we're going to outline a strategy for how you can implement this process into your business. With all that being said, I'm going to go ahead and hand it off to Travis to kick us off.
Awesome, appreciate it, Mark. Happy that these are back, and get the pleasure of having Jerry join us today. And so, one of the first things we'll highlight today is how to really approach overall capital strategy and incorporating it into your bids, and really how people view acting as the bank. And I'll talk more about that in a little bit. But I want to start off with everything has a cost, right? So you should never be submitting bids without, you wouldn't submit bids without materials, with labor. Each individual company has their own line items, but the one that gets missed quite a bit is subcontractor acting as a bank, right? And so the cost of your dollar floating on the street, that's unique to commercial construction. Money moves in construction unlike any other industry, right? None of us can go to the grocery store, get $200 worth of groceries, set a check down and say, don't cash that for 90 days. I'll be back. I promise. So the cost of carrying that capital is something that needs to be included in how you approach winning work, performing work, and ultimately the growth of the business. So, even your cash and your balance sheet has a cost to it and a carrying cost associated with that, which we'll get into more in a bit. But ultimately, one of the largest banks in the U.S. is the subcontractor community, and we'll unpack that a bit further in the presentation as well. But your bank would not let their dollar float on the street for free, and neither should you. So on this one, we'll talk about some of the options that we refer to for working capital. Mark is going to open up a poll here shortly that should be open in the chat on the right side, where you'd be able to vote. What working capital options do you guys use most frequently? Oh, I'm sorry, I didn't do the previous poll, Mark. Is that one still open?
Yes, it is.
Sorry, the first poll, are you guys including the cost of capital in your bids currently? So if you guys could vote on the first poll, it's a simple yes or no. When you do your bidding and estimating now, are you including the cost of capital, whether it be cash, line of credit, and some of the other options we'll talk about here shortly? And then once that one closes, the second poll, what working capital options do you use the most frequently to cover the cost of labor, materials, and equipment? And that should be 5 options there as well. Those 5 options are what you see here. So cash obviously is the most common one, operating off your balance sheet. Traditional lines of credit with a traditional banking or capital institution. your supplier terms, your business credit cards, and then construction-specific financing alternatives such as pay app advance, material financing, and some other options that are out there as well. Give you guys a couple minutes to finish up the poll. Looks like both of those, it looks like the first one's closed. So the results from the first one before we move on to the second one, are you including the cost of capital in your bids? 40% said yes and 60% said no. So we'll have a poll later in the session that builds on this question as well. But 40% yes, 60% no. Build conducts a national subcontractor market report annually. The 2024, and we survey over 900 subs across the country. The 2024 market report had a similar question, and 48% of respondents to our market report said that they include the cost of capital somehow in their bidding process. So we're not far off from the average. Is that second one still open there, Mark? Yeah, I see it. Okay. And so the second question, what working capital option do you use most? You go back to the previous slide, Mark. What working capital option do you use most to cover the cost? 27% of y'all said cash, 55% said lines of credit, 9% supplier terms, 0% selected credit cards, and then 9% selected build products, pay app advance, material financing. So that's an interesting split. When we refer to working capital or capital stack, it makes up all of the available options that you would have that you can see on the screen here. And I would, based on the poll results, right, particularly the line of credit being 55%, I think over the last 10 to 15 years, you would have seen, a lot of revenue growth, top line, bottom line. There was really shooting fish in a barrel in a lot of markets for subcontractor growth and what you're able to accomplish, and turning down projects left and right, labor being the biggest constraints. And then macroeconomics kind of took a change. Interest rates have risen, and depending on the type of work that you do as a sub, we would have seen some of those markets contract both geographically and type of work. And so the point in all that is, I think line of credit use based on this poll and what we're seeing in our client meetings has increased, right? And increased line of credit use to facilitate running the business or operating the business. You pair that up with increased interest rates, right? Back when money was free for the last 10 years, not a big deal to dip into the line here or there. Now that prime +2, prime +3 is the going rate for lines, a sub can expect anywhere from 9 to 12, 13% on their line of credit. And if 55% of you are mainly funding or operating the business with that has a significant cost when you look at it on a project basis or annualize it out. Would that be fair, Jerry?
Oh, yeah, absolutely. I totally agree with that, Travis. Travis, just one thing I want to add as well is, the cost to borrow is a real cost, right? So there's two types of overhead. There's the project-specific overheads, and then there's the business overhead, right? The project-specific overheads are the cost for the management for that particular project, the insurance, the field office setup, and the mobilization, whatever's required on that end. Then there's the business overhead, which is running the back office of the business, which includes administrators and estimators and rent if you're renting your building, your office, and if you have a shop, right, to run the shop. Incorporating the cost to borrow money is a project-specific cost. It's a real cost. Coming from the estimating world, I ran jobs and I've estimated over 10 billion, and I can say that to run a specific project requires upfront cost, and this is an actual real cost. And as an estimator, sometimes you put in the what if costs, right? The risk, for example. So this is why I always, in my on my previous projects, the companies I worked for and the clients that I work with now, I always tell them that this is a project specific cost, and this is why it needs to be put into an actual project. All right.
So cash is everybody's heard the phrase "cash is king," right? Well, cash may be king, and if you can get the business to a point where you can operate it fully off the balance sheet, and there's the opportunity costs associated with managing the business that way are very are diminished, then that's a great spot to be in. But it's just not typically the reality for subcontractors and construction companies in the U.S. that are growing at any type of rate, right? The higher the growth rate, the harder that becomes. And there's other limitations around a cash-only strategy, right? And so cash being the first way to go, you can operate off your balance sheet, but it's one of the main limitations to growth. And so, there's a misconception potentially that you don't need to use financing because you have the cash. When everything's going according to plan, your schedule's built out perfectly, your backlog, your payment terms with your subs and your vendors and everybody that you've got to get paid, your payroll aligned perfectly with the very predictable GC and owner pay schedule to you. When those align, that's all going well. But how often does that all happen, right? It's a high risk game that subs are in, and so when things change, operating off the balance sheet in cash just introduces more risk into the business, right? You're not necessarily in a position to handle all of the curveballs that commercial construction can throw your way from a risk perspective, and unpredictability is really the main one, right? The national average to be paid for subs from time of pay app submission is 57 days. And I feel like a lot of the country and a lot of the subs would be able to build processes backwards from 57 days if it was 57 days every time. It's when one project is 35 and the next is 72, and then they flip-flop the following month when nothing really changed on the jobs, right? And so that unpredictable or nature or inability to forecast incoming cash flow appropriately makes operating off the balance sheet in cash only a riskier proposal. And then it's not only cash and cash is not the only thing that you should take a look in the mirror in, as far as, can I grow as much as I want, or how is this limiting me in other areas? So, your market, your current workforce, labor pool, your ability to finance projects outside of cash, bonding capacity, all of these things are considerations, and we'll unpack some of these further in future slides. But cash only just really limits the options if you're trying to grow year over year and build a buffer or a working capital buffer within the business as far as being able to handle challenges, curveballs, and mitigate risk. It's been said that more contractors fail in the good times than they do in the bad times. And the typical reason is that their growth outruns the cash supply. And then you turn to capital options in a reactive nature to facilitate being in a bad spot. And then that's when there's a snowball effect on how that impacts the business operationally. Cash isn't only about emergencies. There's a lot of things that can be said about having a complete capital stack that goes hand in hand with each other, and that doesn't mean you use all of them. So what I mean by capital stack was the previous poll, right? How do I use my cash, and when do I use it? How do I use my lines of credit? What do I use those for? My supplier terms, how am I getting the most out of my relationships with my suppliers? My credit cards, construction specific financing alternatives. All of those things operate together like a piece of the puzzle that makes up your entire capital stack. And there's just limitations with either using one, such as cash only, or misusing other options in a way that's not good debt or responsible. Anything to add there on this one, Jerry?
No, I mean, it comes down to, it comes down to strategy. What are your short-term goals? What are your short-term goals versus your long-term goals? How much do you want to grow per year? What are you typically going after $5 million jobs, and now you want to start going after $10 million jobs, right? So it's really understanding where you are today versus where you want to go and building out that roadmap. And the only way to build out that roadmap is to kind of understand, like how you were saying, what's your stack look like? What are your interest rates right now? What's your current line of credit? Do you need to increase your line of credit as well? What are the different options to payroll and to get each of these larger projects that you're going after going, where you're able to build that relationship with that GC and not pull off of jobs. I can't tell you how many times I've heard stories, even when I was running jobs with self-performed GCs, where a contractor just wasn't able to re-show up again on a specific project because they just didn't have that cash flow. They didn't have those lines of credit aligned. They weren't thinking in the future like how most contractors should be, or like how all contractors should be, let's say. So back to you, Travis. Thanks.
Yeah, so expanding on our last slide, right? So the considerations for when to use those other sources of capital outside of cash, right? So first and foremost, being intentional about when to use them, right? Financing should have an ROI to the business, right? And cash has an ROI, to a carrying cost with it if you're using your own costs or cash to fund jobs, right? But to take on debt for the sake of taking on debt, or to use a finance option without any clear plan on how to use it, when to use it, and what my return is on that, that's bad debt, right? That's an age-old principle, good debt versus bad debt, right? And so using something for the sake of using it without the ROI would be considered bad debt. So being intentional about when you use your options and having systems and processes in place within the business, both at the project level and the overall operating level, really goes a long way to ensuring that options outside of cash are good debt options. So establishing processes for when to deploy different capital options, right? Construct a good rule of thumb, and most often it's the opposite, but a good rule of thumb is using your least flexible to most flexible in that order. Most often, you would see folks use their cash and line of credit first, as that is typically the cheapest or perceived most cost-effective option. They're also your most flexible, right? And so having construction-specific finance options, having credit cards in place for certain purchases within the business, supplier terms is another great example of an option that's not very flexible. Using those first for their intended purposes, putting a process and system in place for when to use them and how to use them, allows you to protect your most flexible options, your line of credit and your cash, to handle all of the unpredictability and those curveballs that we discussed earlier, right? Everybody on the call has probably been told at least once this week that there's a check in the mail, or that payment is being released tomorrow, some form or fashion of that. And so, you can handle macroeconomic condition downturns. You can handle a bad project. You can handle a couple bad projects. You can handle the loss of a key person on your leadership team. You can handle payment terms on a job going from 45 to 90, retainage being withheld for a year. You can handle all of these things if you have a working capital buffer to continue sustaining and operating the business, and continue operating the business on the growth path or growth plan that you have for 2024, 2025, so on and so forth. But when you use line of credit and cash first, and you leave other options that are not as flexible, what that does is decrease the working capital buffer that you can keep in the business, which decreases your ability to handle more curveballs and more headwinds in the business, so to speak. And so, Jerry, tons of experience. You've done this a lot, getting strategic when evaluating your options. How would someone get strategic what strategies have you used or recommended for how to deploy capital options?
So again, back to the previous slide, it's, understanding your short-term and your long-term goals. In the beginning of this slide, you mentioned good debt versus bad debt. One thing that I always tell a contractor is understanding where you are today. If you're bidding work and you want to grow, and the work that you're bidding and building currently right now is not as profitable as your original estimate said it was supposed to be, then obviously you need to fix your profitability issues. You need to fix why these projects aren't profitable, to start going after larger work and to start pulling more line of credit. It's no longer a good debt. It becomes a bad debt, because now you're investing in a process that's not working too well. So it's really understanding your current state, fixing whatever needs to be fixed. We all can work better than we did on the previous project, right? So it's really understanding who you are as a company, the resources you have, and what's going to be required to get to the next level. If you're a civil contractor and you're a heavy equipment contractor, and each piece of equipment costs you $200,000, you need to do an equipment forecast, for example, and that's where cash really is really top of mind for me. Is when you need to buy equipment, you could buy that equipment using cash rather than financing that equipment, right? And then using that line of credit to fuel buying materials and getting your current projects up and running, or your future projects up and running. So it all comes down to where you are today, where you want to go, and building out that roadmap and understanding what your stack is, right? Do you need to increase your line of credit as well? As you're growing, you're going to need to increase your line of credit.
Yeah, that I could go on a whole. If you can go back to that last slide, Mark. Sorry, I could go on a whole diatribe about lines of credit and why they're not built for subcontractors, but we'll save that for a different one. Some considerations around when, these are just some example processes that you could employ at the business level or specific project level on when and how to use different forms of capital, right? And so some of these examples, projects with certain GCs, and I know Jerry's going to hit on this in a little bit, but if you know that a GC is somebody that you might have stopped working for them in the past for XYZ reasons, and they still ask you to bid on their work, or you just know that the owner they're working for, a client in this particular case, takes a very long time to pay, right? Well, you can take on that project as part of your normal process and just deal with the ramifications and the margin erosion. Or you can have a process in place that says, for this GC or for this client, we have X amount in our bid for us, waiting 90 days to be paid, right? Material purchases with certain suppliers, vendors, manufacturers that offer a decent discount for early pay, right? Or you have the ability to negotiate those discounts. Project contracts over a certain amount or a certain percentage based on your revenue. So if you're a $10 million contractor and you land a $2 million or $2.5 million job, well, that introduces an extra level of risk into the business based on how that project goes, right? Not your resource allocation, but also the cash flow that accompanies it. So accounting for that risk on the front end. Your outstanding receivables over a certain threshold, right, or a dollar amount relative to your annual revenue. Cash reserves. Maybe you're an owner that only wants to grow 5% year over year, and you're happy with where you are. And managing people sounds terrible, but you like to have a certain cash working capital buffer, cash reserves in the business to cover X amount of weeks or months of expenses. So these are all different examples of processes that you can put in at the company level that dictate when and how you use your various forms of capital. So we've gone over some of the options. We talked about some of the processes. It's obviously unique to your business. So now we can take a look at Jerry's expertise, right? How do I actually do the process or complete the process of including this into my bidding and estimating phase?
So, Travis, at the end of the day, this is just one big educated guess, right? Nobody really understands what the future holds, but we got to take what we have today, what we understand today, based on the data, the historical data from the previous year or previous projects, or like how you were just previously explaining, the GC reputation as well. So the goal of this is to develop an educated guess of how much we need to put in a future bid, so we're covered and we're not taking this cost out of the bottom line, the profit, which I see a lot of contractors do. So it's a real cost, like how I mentioned before. So in this first step, you got to determine where you are today. What are the account balances you have today? What are the lines of credit you have available to you today? Hopefully if you're a smaller contractor and you don't have a full accountant department, a CFO or a controller or a bookkeeper, you'll probably have to do some of this legwork yourself, or you got to work with your accountant. If you got a good accountant department, this first step should be a lot easier for a larger contractor versus a smaller contractor. So again, you have to understand where you are today. What are your lines of credit that you have available to you today, and develop a plan moving forward from where you are today. The next step is, what is the incoming cash flow for the months ahead? What are your accounts receivable versus what are the pay requisitions to the owner? So basically, this is about the current contracts that you have going on right now. I would say you plan this out maybe every year, or if you are a larger contractor and you're going after larger work. I know on my previous employer, almost every project was in the couple $100 million, right? So it was a lot easier because we knew each project, there was only so many couple $100 million jobs we were able to land per year. But if you're a smaller contractor and you're bidding tons of work each week, then maybe you break down per week as well. But at a minimum, you'll go out 6 months, 12 months on a per month basis, and then what you'll do is you'll break out on a per week basis. Naturally, most contractors get paid on a net 30 pay term, right? So it's every month. Then your next step is estimate your outgoing expenses, your cost of goods, the labor, materials, your back office, your administration, your debt services that you have currently in play, the rent, your leases, and et cetera. And again, you'll go out several months, 6 months, possibly a year if you can, and then you'll break out maybe the next couple of months into a per week basis. The goal of this is to make this as easy as possible. Nobody really can predict the future. So again, we're using historical data. You're using the relationships that you have with the GCs, what you have going on right now. It's important to understand what part of the year you are as well. If you're approaching, now we're in election year, right? So a lot of contractors that I'm talking with are complaining that the business is slowing down. Then before you know it, after elections, it's holiday season, right? So your pay requisitions are going to slow down, or a pay requisition. I call them pay requisitions, which is the monthly bill that you invoice to the owner or to the GC. Every company kind of has their own wording. But if you're approaching the holiday season, you gotta assume that a pay requisition is going to slow down. It's going to be a lot smaller. So you need to keep all these points into consideration. Your next step is to subtract your incoming cash versus your outgoing expenses on a per month basis to kind of understand where you're going to be for the next 6+ months per month, incoming versus outgoing. Now your next step is to take your future project that you're going to be bidding and create a project-specific schedule. Again, this is if you're a smaller contractor and you're pumping out a couple of bids per week, maybe you can try to find a way to lump in several projects and kind of come up with an educated guess of how much work you can potentially pick up on that per month basis. If you're a larger contractor and you're bidding 10, 15, 20, 50, $100 million jobs, it'll be a little bit more easier to predict and create a project specific schedule. So some of the things that you need to consider on your per month projections. First of all, it's, we're recording this on July 24th. Let's assume that the contractor is telling you that your project start is going to be on September 1st, right? We all know that that's probably going to get pushed. So many things could happen in the next couple of months that can potentially push that. Next thing you know, now you're in the holiday season, and then sometimes you don't get going in 6 months. I was just talking to a contractor not too long ago, and she bid and she landed 4 jobs. Each job was supposed to start a month and a half, 2 months apart from each other. She says, Jerry, now I'm in a position where all 4 of my jobs are starting at the exact same time. Well, I'm not going to say that I can't. I have signed contracts, so I need to get going with those contracts. So again, it's really understanding where you are and trying to really predict where things are going to go. The first thing you got to determine is your mobilization. What is your mobilization money that you can receive from a particular GC? I know I just had a conversation with a GC that they're entitled to 4% mobilization. They have a $40 million job. They are the GC, actually. But the problem is that they're not going to be receiving their mobilization of that 4% all in one shot. It's going to be broken down into X amount of months where they're also going to be having to give up their 10% retention as well. The reason why I'm talking about the GC situation is that as a sub, you need to understand what the GC situation is. And you can easily do that by going into the specs and understanding what money you can get up front. Obviously, you want to get as much mobilization money as possible. But not many contractors are going to give you, because they're getting 4%, it doesn't mean you're going to get 4% because you're one of many subcontractors as well. Their upfront cost is probably a lot larger because they also need to set up the yard and the offices that you are also going to be sharing as well. So it's understanding what the mobilization is and how much you can get up front. These are conversations that you can have prior to a bid. I know I've looked at thousands and thousands of subcontracts or proposals prior to bids, let's say, and they'll be very specific. For us to do this job, we need $100,000 right off the bat to get going. So you need to understand that the GC understands that as well. And then if you don't get that mobilization, this is where this whole process becomes even more important, right? So you need to understand that. Also, you need to break down your first month, your second month, your third month, your incoming versus your outgoing expenses. Again, this is an educated guess. You need to just be conservative. And the way you develop this guess goes back to what Travis was saying before, as well as understanding the GC you're dealing with. Working for self-performed GCs, where we did our self-perform work and we also worked for a lot of subs, I can tell you, GCs don't pay you until they get paid, right? That's just the rule of the thumb in the industry. I've talked to a lot of subcontractors who specifically say, we're giving you a better price than your competition because we know you guys are good payers. So obviously that plays a major part in developing this per month revenue versus outgoing expenses as well. So what I like to do is I like to develop a simple Excel spreadsheet where you're going to have your mobilization, you're going to factor in your retention as well, which is typically 10% retention as well. And then you're going to go out X amount of months wherever you feel you're going to become cash flow neutral. I would always recommend extending it several months beyond that as well, because again, back to our previous conversations, you never know what's going to happen. Again, if you're approaching the back end of the year and you're going to start getting hit with holidays and winter shutdowns, if you're a concrete contractor and you're working in the Northeast or in colder climates, you got to keep all this stuff into consideration and be conservative. At that point, you're going to be able to determine on a per month basis how much cash flow you need per month for X amount of months, and you're going to compare that to the first couple of steps, which on this slide is your first 4 steps. And then you're going to determine how much cash you need to borrow to cash flow that project. And then at that point, you're going to have a strategy, and you're going to be able to understand, are you going to use cash? If I keep talking about heavy civil contractors. Heavy civil contractors require a lot of money to buy very expensive equipment. If you're growing as a contractor and you need to buy several pieces of equipment, and you know you're going to need to buy $500,000 worth of excavators and backhoes and trucks, whatever it may be, are you going to use cash for that? Are you going to finance that? Are you doing an equipment forecast, which is probably another topic? Equipment forecast is understanding if you're going to lease a piece of equipment, are you going to rent a piece of equipment, or are you going to pay cash and you're going to buy that piece of equipment for that particular job? But I'll tell you this, I know a lot of contractors who buy equipment, and that equipment is only good for one project for 6 months, let's say, and it's sitting in their yard and it's collecting dust. So it's understanding and have a really good strategy of who you are today, where you are today, where you want to go, what's your finance stack look like, and understanding on a per project basis, especially if you're looking to grow and you're going after larger projects, understanding what the cash flow is required for that project, understanding where your company is and what you have available to you, and really understanding your niche and what's required for that specific project to move forward. So, Travis, I think I hit this well enough, but, one thing I want to tell people is start off with simple Excel spreadsheets. I'm all about simplicity. I'm all about if you're the owner and you're the CFO or you're a project executive and you understand this more than the person that you're training or a junior employee, how do you make this as simple as possible where you can pass this on to a junior employee one day and develop a process? Because I'm all about task delegation and provide a process for a junior employee where they can understand this. Yeah, they're not going to understand the number one part of this is understanding your account balances and your lines of credit that you have available. But where you could do minimal work in the future, where a junior employee could take this information and provide this cash flow. And then just understanding how much cash flow you need per project, what capital stack you're going to be using for that particular project based on where you are today, and understanding what interest to bake into your bid. And this is going to go into your overhead, and if it's a unit price job, you're going to spread that accordingly into your unit prices. Another way I help clients is, understanding how to front load a project. And you got to be careful when you front load a project, because when you front load a project, you better be really good at your expenses, right? Because you don't want to take in all this money, all this cash, and to go spend it. And then now towards the back end of the job, you don't have any money in the bank, right? So you got a cash flow, or maybe move that cash from your front loaded items, which are the items you're going to be hitting first on the job, so you can get as much cash flow, and the kind of spreading that evenly over the items that you're going to be doing in the middle of the job versus the back end of a job as well. If you're a specific niche where you're directly in the front, you're a one-shot contractor where you're going to come in, you're going to leave, and you're done with that project, great. You can evenly distribute your overhead costs, which is this cost. If you're, let's say, an electrician where you got to come in, you got to fit out the interior of the walls, then you come back and then you would start installing your hi-hats later on. You got to be able to distribute this overhead properly as well. So, Travis, what else you got?
Well, you're just going back to a comment we made earlier, right? This is one piece of a very large, complex puzzle, yes. Right? And some of the things you're hitting on, right? Having processes and systems in place for your capital stack, having processes and systems in place for contract term negotiation, for operations. I mean, you could apply this principle to any part of the business, but you're hitting on a lot of them, right? How do I negotiate higher mobilization? Is this a GC and client that I can bill for stored materials? How do I get that into my contract, right? If I can overbill my first 3 pay apps 7 to 8% over actually what I did, how does that offset a 10% retainage? And where does that, where does those cash flows line out, right? To Jerry's point, simplicity, this could start, with maybe 3 rows and a couple columns in Excel, and you could be a $20 million contractor in a few years, and you've got hundreds of rows, line item costs, and then the most important part comes into play. After you close the job out, you go back and job cost everything. Like, how did I actually perform against what I planned, right? Because that's the only way to make iterations and improvements for future work and future bidding. But negotiating retainage from 10% down to 5%, if that's what's in the prime contract, right? Using some of your capital options to get to cash flow neutral, as Jerry mentioned, without having to bankroll or finance the whole job, right? These all become pieces of the puzzle that is going to be unique to your company, but it's not as simple as my line of credit cost me 10%. I add this X amount to my bid and we're on down the road, right? It's no, I use this finance solution here. I use my cash here. I do this on these projects and I do X over here. And then you have to put it all together to get a realized cost of actually what your carrying cost is and what your debt cost is. Because some jobs you might not need to do anything. It might be perfect to operate off your balance sheet. And other jobs might, really require some in-depth. So depending on where you're at in your revenue and your business's life cycle, the resources that you have available, that can all lend itself to how detailed you can get with all of this.
Yeah. Now, Travis, I just want to say one more thing. For anybody that's listening, I've estimated well over $10 billion worth of work, and I understand your frustrations. It's really tough to find estimators. It's really tough in this ultra competitive market to win work, especially if you're in the public works sector where there's so many different contractors. Travis and I have this conversation all the time. It's very easy to put money into a bid. Very easy to put money into a bid. But this is a real cost. And a project's profit isn't real profit. That profit goes to paying your back office and your estimators and everything else. But you got one of two options. Either you're not going to put this cost into your bids and it's gonna erode your bottom line, or you're going to put this cost into your bid, which is a real cost, which I've done for many years, and you're going to win a job based on being able to do a phenomenal estimate and coming up with some really good productions that you're very comfortable with, putting the right team on a project and beating the living daylights out of that project and being able to increase your profits. But this is a real cost, and you need to understand that this is I know a contractor who spends several $100,000 on borrowed money, and it's just a real cost, but he's too worried about putting it in his bid. So it comes out of your bottom line. So it's a decision that you got to make, and there's ways to get around it.
Yeah, Jerry, I think you just hit on this slide, so we'll go to the next one here.
Yeah. You want me to take this slide, Travis?
Yeah, I have it for you, but I can take it. Or go ahead. You got it.
No, I mean, ultimately, knowing your stack allows you to have an advantage because it increases your confidence, right? Estimating is, for the sake of this presentation, it's about estimating and how to incorporate this in your estimate, right? So it increases your confidence by really understanding where you are today, what your capabilities are, and where you want to go. It allows you to take on larger work, right? We've mentioned this several times. How are you going to take on larger work if you can't pay your bills today, if you're not profitable on your jobs? Also, now more than ever, I'm hearing that GCs want subcontractors to be bondable. GCs are learning, and unfortunately, they're making you payroll the project, right? They're making you cash flow the project. But on top of that, they want you to perform as well. And they're not going to pay you unless they get paid. So what are you going to do? Are you going to fight the entire industry where every subcontractor and I talk to contractors in all 50 states. Everybody's has the same complaints, right? So what are you going to do? You got to be prepared. You got to be prepared that if that contractor is not going to pay you net 30 and they're going to net 60, what is your option? You can write nasty emails, you can call your lawyer, you could talk about leaving the job, or you could be prepared knowing that the contractor hopefully is eventually going to pay you, and know your options that are going to cost you money, that have been baked into the job, that you know you have the funds for, to continue to build a relationship for that specific GC, especially if you're in a growth stage and you're going from a GC that does $100 million a year. Now you're starting to bid with the big boys, and you're starting to bid with the really big contractors. They want to know that you can finish that project. They don't want to know that you're complaining that you can't cash flow a project, because it is an issue. So that's what I got with this slide, Travis.
Yeah. So just to recap, so some of the things to consider, when determining the cost of your capital, we talked about this one, right? Your day sales outstanding, blended across the business, right? How many days are you carrying the bag or floating the cost? But then breaking that out, depending on the size of your company, keep it simple to start. But if you're more complex, multiple, 10, 15, 20 GCs a year, breaking that out per GC, ultimately per client as well, right? Because the GC's subject to client payment terms or owner payment terms as well. And so the more you can build out, the average time, a work history with someone, the average time it takes to be paid, the more you can fine tune your carrying cost as the sub. Financing costs, right? Having financing options in place before you need them, and then knowing the costs of them. So having those processes and systems on, I use this option at these times, can go a long way to really minimizing the ultimate landed costs of your options. And then the different capital options, that you have, how do they mitigate risk? So this goes back to what we talked about earlier, flexible versus, or on a scale to not being as flexible, kind of flipping that around, right? Having the processes in place for my non-flexible options all the way to protecting my flexible options to handle some of the curveballs and mitigate the risk overall. And then just the last one, we talked about this as well. Cash, your cash isn't free. So you might be in a position to operate off of your own balance sheet, but there's opportunity costs associated with it. There's short-term investments, there's long-term investments, key hire, building out your capacity, equipment. There's opportunity costs with operating off your own balance sheet. And maybe those costs are, maybe what they are and they're okay, right? And you're okay with that as the owner or the executive team. And that's perfectly fine as well. But having the conversation about the opportunity costs around using your cash and balance sheet is a conversation that definitely needs to be had. And so to that point, right, there's a cost to carrying slow payments. This is a simple formula. It can get, to Jerry's point, right, simplicity is great. It can get much more detailed, depending on your financial acumen and what you track and keep track of in the business. But for you the average time to be paid being 57 days, right, the costs that one of the costs that is everybody's subject to is waiting for slow construction payments, right? Which is going to slower growth or limit growth, resulting in lost profit, right? So every business needs profit in order to grow, right? That money is being invested, income producing assets, new projects, anything that drives more revenue. But a simple formula, take the inflation that's happening at a monthly rate, right? Your most used capital option, you can take the rate or the cost associated with that. And then potential profit is the one I was just talking about, right? That's the one that gets missed most often. How do I put a dollar amount or a percentage to those opportunity costs associated with what I'm not doing based on the constraints that I'm subject to? one of those constraints is waiting 60 days, for your money. Getting those funds in 2 weeks earlier, 3 weeks earlier, the turns on that cash and what I'm able to reinvest in within the business, it takes some math and some serious thought and consideration, but you can put amounts to it that can be input into a formula that says every month that goes by that I don't collect money that's on the street, it costs me this amount. In this example, 6.17% to carry slow payment, right? That doesn't mean that you're going to be able to solve slow payment tomorrow, but to Jerry's point on a previous slide, how do you prepare for it? How do you prepare for the realities of the industry, not only for today and how you operate now, but where you're trying to get to from a growth perspective, from a future revenue perspective, exit strategy, right? You've been operating the business for 20 years and you want to get out. How do I get the highest multiple for my business if I want to sell it, right? So, slow payments can obviously limit the growth, like we talked about. And then if you have in-house accounting or you're preparing accurate construction reports, you can quickly identify your average monthly profit rate. Take your average profit, compare it to your job profitability reports. You can get very in depth in the numbers, and it can only help further drive or weigh in on decisions on how the business overall deploys capital and their strategy for going after work. Brenda had a great comment in the chat, and the next slide we'll talk about this further. But this is one piece of a very large puzzle, and you can look at individual finance costs on an individual project and easily track that all the way into, well, how does the business overall pursue work, right? And how does our capital strategy and our options that we have available to us affect how we pursue work? And we'll talk about that a little bit in the next slide. So, and just to recap, so knowing how much slow payments can cost everybody is not meant to be a depressing exercise, right? This isn't meant to be doom and gloom of the industry. It's really meant to help you understand your business better so that you can be accounting for costs appropriately and then taking steps ultimately to reduce those costs and manage them as much as possible, right? So knowing the cost of slow payment, how it affects the finances of the business, how it affects the strategy, how it affects operations. Knowing the true cost of slow payment can actually ultimately help you put processes in place that allow you to be paid faster or grow more or increase profitability. And so, what I just talked about, one of the benefits of including the cost capital is really a recap. So increased profitability. We talked about at the beginning of the presentation, 48% of contractors account for the cost of capital. In our market report, you guys answered 40% here. But of those contractors that account for the cost of capital, they also reported nearly 2 points higher on average profit margin than their peers who didn't account for the cost of capital, right? And so not only are you increasing profit margin on the back end by putting these processes in place and viewing carrying cost as a true cost to the business, that allows you to put other processes in place that will also drive increased profitability. So, maintaining cash reserves. Every business is unique on the opportunity cost. So what you would be doing with cash if you had more of it. But I ask clients all the time, if I were to ask you or your significant other, what's the what amount of funds or how many months of funds would you want in your personal savings account to plan for emergencies or just to have on hand? The answer I get most often is 6 months. At Build, we run a cash flow analysis tool that takes a look at how money moves through the business currently, and then based on where you're trying to grow, we can show a P&L and a cash flow statement based on that future revenue. That'll show working capital needs. And what I'll tell you is when we go through the working capital the exercise to add up all the available working capital currently, the average amount of time that I see on hand as far as available working capital is 2 to 5 weeks. So that's 2 to 5 weeks of cash or working capital on hand to cover 2 to 5 weeks of expenses. So if all incoming payments stop tomorrow, I'd be able to fund the business for 2 to 5 weeks. The healthier businesses, are 6 to 8 weeks, but these are weeks. These aren't 6 months. This isn't, you've got potentially hundreds of employees on your payroll, significant obligations, to your clients, and it's just commonplace for businesses to operate in construction at 2 to 5 weeks of expenses, and it's just considered the norm because it's the way it's always been. And you talk to your counterparts in other trades or in other markets, and they're like, yeah, it's kind of the same. But you ask somebody their personal finance, and they're like, no, 6 months, right? And so the maintaining the cash reserves in the bank is not only, it's not just to put extra money in the bank and hope nothing bad ever happens. It's really to de-risk, de-risk what you, how long of a runway you have, really. And so, risk mitigation is the name of the game. Everything can be tied back to that in one form or fashion, but it's just commonplace in our industry for subs to be okay, operating 3-4 weeks of expenses as far as cash on hand. Jerry, you want to hit on, how it allows you to scale, and then particularly the GC relationships and partnerships?
Yeah. So, I mean, to kind of cap everything up, I'm an operations guy, so I'm always thinking what would give somebody a competitive advantage, right? And it all starts with relationships. How do you build relationships? You build relationships by developing trust, right? How you develop trust as a subcontractor with a GC and an owner is by getting the job done. Is by having them give you a chance to perform a specific project, getting the project done without giving any issues as well. Now, the GC needs to do their fair share of the deal as well. But how do you do that? It requires that money. It requires that cash to get the project rolling and to be able to provide the project with the resources that are required to get the job done. I mean, there's so many stories that I hear where contractors aren't able to mobilize certain equipment because they didn't, they just didn't have, and they'll admit they just don't have the money to mobilize or to buy the proper equipment for that particular project or to bring the materials there. So they'll pull their people off the job because the materials was several weeks later. And then I would hear from the foreman, no, it's because we just weren't paying the bills and our supplier locked our account. I mean, I've probably heard about 50 of those stories in just in the past 20 plus years. So, increased profitability, maintains cash reserves in the bank, mitigates risk, schedule delays, holidays, project shutdowns, and whatever that entails for your specific niche. It allows you to scale, right? You need money. It takes money to make money. It's a true statement. It really is a true statement. Strengthens and I just hit on why it strengthens GC relationships and partnerships. It allows you to build the trust and to develop a long-term relationship. Warren Buffett once said it takes 20 years to build trust. It takes 5 minutes to destroy it. So don't let that specific project be that 5 minutes of you not performing well.
So I know we're coming up on time here, folks. Reminder, you can put questions in the chat, and we'll go a couple minutes over on questions if people want to stick around. So really recapping, or one of the final major pieces before implementing a process, right? It's you're all on this call, right? Hopefully you're learning something, you're going to get something out of it and take it back to your businesses. But who else needs to buy in, right? Who else do you need to talk with to get a process or system put in place? And so you want to do the next slide, Mark? And so I'm not going to read each of these side by side, but just in general, the principle is if you're on the finance team, what is estimating and pre-con going to care about you coming to them with how much your line of credit costs, right? Like why would they care? What does that matter, right? Operations, the importance of overbilling on a job, the importance of tracking change orders effectively from the construction team and operations team. How do I get all of these folks at the executive level to buy in on our strategy as a company on how we deploy capital, how we pursue work, how we mitigate risk, and then how do I get all of these thoughts and ideas actually deployed in the field? And so, step one, I would say don't operate in a silo and ignore the other parts of the business that need to make this go forward, right? And so outlining the costs, standardizing your working capital options all can be done on the finance side. At the project level, like I said, meeting with your pre-con team, why is this something that they're going to care about? Operations, why is this something that they're going to care about? And there's more strategies we can unpack there, but ultimately this isn't something that can be deployed at the broader business level just from the finance team or the back office teams. You need buy-in and execution from other parts of the business. Mark, you want to go next slide? So that concludes the presentation here. A little bit about Build, and then Jerry's going to speak a bit about ProExcel, his company. Build, we're the largest construction-specific subcontractor finance partner in the U.S. We have a few different products that function together, like project-based lines of credit. We're meant to be a part of the capital stack, how you manage cash flow, how you deploy different capital strategies. And additional, financial resource that overlays with your standard business and into your capital stack. We also have some tools, like I mentioned, the cash flow tool that we can go over as well. Jerry?
So quickly about me, I've been in the New York City construction market for over 20 years. I've worked for several leading contractors ranging from $100 million to $1 billion a year. I ran over $300 million of my own work in addition to several hundred other millions of dollars worth of work as well. I was a senior estimator, estimated over $10 billion worth of work. I now help contractors build and grow profitable businesses. How do I do that? Is I focus on their operations. It's either typically through strategic growth planning, where we figure out where you are today, where you want to go, and develop a roadmap or realistic goals, or perform an operational performance assessment where we can improve your operations, which will help you with your growth as well. So I could be found on LinkedIn, pro-excel.com as well. And reach out to me, Jerry at pro-excel.com, if you have any questions.
Thanks, Jerry. The last poll is open. You can vote on it if you'd like to meet with Jerry or a member of Build, and then the Q&A session is open as well. You guys can put questions in the chat.
Absolutely. We're a little bit over time. If you have any questions you want to pop in, we can definitely get back to you on those with some answers. And thank you, Travis and Jerry, for a phenomenal presentation. And thank you to everyone for joining us. I love seeing all that activity in the chat. So thank you so much for participating. We really appreciate it. We're going to send out a link to a recorded or on-demand version of this webinar sometime this afternoon, so you can view it yourself, share it with your team. And we'll also follow up with some relevant content that you might find interesting. Thanks again for joining us this afternoon. Please stay tuned for some invites to Build meetups in the future, and have a great rest of your day.